Welcome to a new year of investing and the latest edition of The Bull, the Bear, and You as we navigate what is happening in the economy and we'll take a look at investing. I'm Stacy Smith and I urge you to subscribe or say that you like this podcast on whatever platform you happen to be using. Well, 2024 saw some very healthy gains in the stock market. It is now, though, a new year and things look a little different. Wall Street is interpreting some good economic news as not so good. We'll take a look at that. We'll explain it. Also, we'll take a look at bonds, and we'll also have some comments about the housing market. It's coming up on The Bull, the Bear, and You. With me to talk about the economy and investing is my panel of financial advisors and experts, and they are Carrie Coghill of Coghill Investment Strategies in Pittsburgh, Frank Rossetti of HF Management Company, Kim Forrest of Boca Capital Partners, and Michael Godwin of Fregasso Advisors. I trust all of you had a great holiday period and looking forward to this new year.
Yes, sir.
All right, good. Well, you know, it has been a month since we last met, and in that month, the markets have been moving. Here is a quick recap. All of the major indices closed 2024 with substantial gains. The Dow was up nearly 13%, the Nasdaq up 28%, and the S&P 500 gained 23%. That looks great, but even before the year was over, the markets began to slide some, especially the Dow. On a percentage basis, the decline of the indices is not all that great or significant. However, the latest economic news is troubling to investors. Some very good news on the job report shows that the strength of the economy triggered a sell-off on Friday, on January the 10th in the markets. So it does beg the question, if the economic news is good, why did Wall Street think it was such a piece of bad news? And does this slide now pick up some steam, some momentum? And Carrie, you like to say, when we get a pullback like this, it's a buying opportunity. So is this a buying opportunity?
Well, the question is, historically, any market decline has resulted in a buying opportunity. But the question is, exactly when does that buying opportunity happen? I wouldn't call what we've experienced in the last few weeks quite the compelling buying opportunity that we might be looking for. More so what we're looking for is, potentially a technical correction in the market. Once you get into that 5 to 10% decline range is when you start when we generally start looking for some opportunities. So I think that what the market is telling us right now, what a lot of the data points are telling us is that the economy is actually strong. When we look at a variety of data points that we've received, you mentioned the jobs report, but even when we look at manufacturing numbers and new orders with manufacturing, we really get a sense that, the economy is actually functioning quite well. Now, it's counterintuitive, right? Well, why is the market down if the economy is functioning well? It all has to do with interest rates and cost of capital. So these interest rate declines that everyone expected and wanted and probably aren't going to get really causes a repricing in the market. And, it's believe it or not, it's healthy. These types of we call them technical corrections, where the market kind of gets ahead of itself based on certain factors, and then it will tend to sell off for no other reason that we have a repricing going on. That's really when we would be looking for buying opportunities. But this volatility that we've experienced lately doesn't quite get us to the point where we would need to be.
I think it depends on also
the healthy thing that Carrie mentioned.
Go ahead, Frank.
The healthy correction in the market we haven't had yet. A correction is 10 to 20%. We've approached 10 a couple of times in the last 6 months, but I don't think we've quite gotten there in the Standard & Poor's at least. That being said, like a spring rain cleansing, the market kind of needs it. We've had 2 years in a row of 20% increases in the Standard & Poor's. That being said, that's only happened, I think, 5 times. And correct me if I'm wrong, but I think I read that somewhere. And it doesn't happen very often. and I don't think it's ever gone up 20% 3 years in a row. So it's reasonable to think that we're not going to see 20% upside in 25, simply because it's never happened. But there's a first for everything, I guess.
But
And
you're not, but Frank,
if earnings come through, it'll be in good shape.
but you're just saying that there may not be another 20% gain in the S&P 500. You're not calling necessarily for a decline in the S&P 500.
I think we're due for a correction. For it to go down 10 or 20% wouldn't disturb me at all. And it would be, as you led this, as a buying opportunity in my mind. Earnings are strong, employment is strong, it's not likely to change. Trump's policies, although some of it will be inflationary, some of it will be growth oriented, I expect to see that happen. And there'll be some industries that get disjointed because things are changing. And they're changing worldwide. It's not just this administration. It's a worldwide change. And that'll cause some disruption here, but there will be winners and losers. And that's our job to figure out what that's going to be.
All right, Michael, you were going to say something.
Yeah, I think it just depends on your time horizon too. I think I said last time on the call that my highest conviction call for 2025 was that we'll have a 10 to 15% correction. I don't think that's too out of the woods or anything like that, but I don't really want to sit around and wait for that to happen to necessarily buy. For example, I mean, I'm in my mid 40s. I just made my backdoor Roth IRA contribution today, so I bought into the market. I have a long time horizon. I'm happy to weather a down 10%, down 15% drawdown if that happens. I think I was on record saying I thought that was going to happen in spades last year, 2024. It didn't. So I don't want to wait around necessarily for that pullback to invest in the market if I have a longer time horizon. If you're somebody who's a lot more nervous and cautious and you have some cash on the sidelines, dollar cost average your way into the markets over the next 6 months or so. Back to your question on why the market is sold off, Stacy, I think it's one answer and one answer only, and that's that the Federal Reserve is less likely to cut interest rates in 2025. In fact, they might even have to raise rates as opposed to cutting them this year should inflation remain a bit stickier than they anticipate. So, we talked about, Kerry mentioned that the economy is good. I think the economy is very, very good. But the stock market is not the economy as we're seeing right now. So I think that's really what's happened so far this year.
If you were on Wall Street and you said that the Fed might have to raise interest rates, they'd be chasing you down the street with pitchforks, I think, at this point.
I don't think they will, but I don't think it's out of the realm of possibility as it might have been 4 or 5 months ago.
Yeah, exactly. Things have changed. Kim, what are your thoughts?
So I'm going to be the outcast, the weirdo, no, I don't think things are going to double or triple or whatever, but listen to me on this one. I agree. Fundamentally, bond prices are telling you something. Each time it's different, though. But I want to talk about something more basic, the actual construction of indexes. Both of the big ones that we watch, the S&P 500 and the NASDAQ, the Qs, right? They both feature, I would say, the stock of the decade. I'm going to give it that. I don't own it. I regret this, but Nvidia. Over the weekend, I was doing some thinking about this. Right now, every time you buy either the Qs or SPY, the index, or the ETF that represents the index, the S&P 500 index. There we go, got it out. You're buying 15% of your money in Nvidia, okay? And let's see why. And then I'll answer your question about what's gonna happen in 2025. So in 2020, these are yearly numbers. Nvidia had about $11 billion in sales for the year 2020. Jumped up to $16.5 billion in 2021. It jumped up to $26 billion in 2022. 2023, about $27 billion. Oops, 2024, $60 billion. And and by the way, the company's end of year is January 31st. Okay, so this year they're on track to be $113 billion. Okay, that huge, unheard of ramp up in income, in revenue, drove the stock price. And it then drove these indexes. In 2024, as Nvidia got bigger, the index bought more of it because it became bigger, right? Because it's a market cap weight index. So the bigger your company, the more influence it has. Now I ask you, do we think really Nvidia is going to double again and be like 100 or 230 billion in revenue this next year? Not bloody likely for many reasons. So this is going to leave maybe an air pocket for the S&P 500, and God bless the Dow that just added it, right? Like whatever the Dow does, do the opposite. I've figured this out. If they add something, they always come late to the party and then they get clobbered, but God love them. So I think this nerdy little aspect of one company having an unbelievable amount of influence on the indexes is going to make for a difficult maybe 2 years with respect to an index. Now, I am a pure stock picker. I'm looking for companies that have growth markers but at a reasonable price. No, I'm not buying Nvidia right this moment, maybe someday in the future, who knows. But you know, there are opportunities. Don't give up. But if you're living and dying by this index, I'd beware and you know, be a math nerd. Sit down and put your pencil to the paper and see how much Nvidia has really influenced the market this year.
Okay, let me back up for a second on this. So my question would be, given what you've just said, Kim, is that if Nvidia has this much influence on the SPY and the NASDAQ, the Qs, then what does that mean for the other stocks that are in those indices?
It's their time to shine, baby. You know, like, but here's the problem. They are probably not going to grow enough to boost up the index. But if you maybe don't have the biggest performers that have driven this index for the past 2 years, maybe your results will be higher. And, you know, who knows? I say that with, you know, a lot of asterisks, a lot of carrots. But if you are looking to outperform the market, these next couple of years might give it to you because of this unbelievable sun that we call Nvidia, that apparently all other stocks revolve around at this point.
So then that leads to my second question. Anybody can jump in on this one as well, that if you are correct in your analysis on this, Kim, and I don't think that you are incorrect, that would mean that if someone holds a long position and a lot of SPY or Qs, you're going to see some drawdown on your holdings in. Is that what you're projecting?
I mean, I don't know that it would be as much potentially a drawdown, but you're just going to have some major headwinds because if other stocks in the index do well, you know, what's the offset of that? I think the real lesson here is numbering, and Kim just said, if your goal is to outperform the market, well, guess what? Change your goal. Maybe your goal of outperforming the market isn't a good goal. Maybe your goal should be, how much do I need to earn in order to make sure that my assets, that I won't outlive my assets? So, you know, this is where the planning comes in. The other thing is that there are exchange traded funds out there that have what's called an equal weight to the S&P. So it owns all of the stocks in the S&P. It just weights them equally. So there definitely are some alternatives. But, you know, the goal of wanting to beat the market is kind of obscure to me.
Yeah. Okay.
And let's talk about
right,
that equal weight.
Go ahead.
Let's talk for a minute about that equal weight
Sure.
ETF. I own it. And that thing, and sarcasm is intended here, only did like 13% last year. The dog. I mean, it wasn't bad. All right. Was it crazy? No. But it's not built to be crazy. It's built to be less gut-wrenching.
Yeah. Okay. All right. I want to move on to something else here, and Michael kind of brought this up, as did Kerry. What cannot be ignored right now are the bond yields. They've been on the rise since the Fed started to lower interest rates. So I guess the question is there a chance we could see the same scenario that we went through a couple of years ago when bond yields increased, the price of bonds went down, and stock prices went down? And so not to be a harbinger of bad news here, or one who thinks that things aren't going to work out well, but does this trigger a reason to change your stance in your portfolio? But let's just get into the bonds just for a second. Michael, can you help us out on this as to why we're seeing the bond yields go up at the same time that the Fed started to lower interest rates?
Sure. So you're seeing the longer dated bond yields go up where the Fed doesn't control the interest rates. The Fed controls the interest rates on what we call the very short end of the curve. Treasuries that mature within, call it 2 years or less or so. And the reason why that yields are going up is really kind of twofold. I think one, growth kind of remains still strong in the U.S., as Carrie and Kim pointed out. Two, inflation expectations are a little bit more elevated than the Fed may have anticipated. I think might be a little bit stickier, so it's kind of remaining a little bit more elevated than what they initially thought. And then three, you can make the argument that that's somewhat because of like Trump's supposed policies coming down the line or whatnot. So you're starting to see the yields stay a little bit more elevated. And I think the main reason is because of those inflation expectations here. So your question, could 2022 happen again? Absolutely. There's no reason why it couldn't happen again. Prior to the 1970s, bonds and stocks were actually somewhat positively correlated. So bond prices went up, stock prices, meaning yields went down, stocks went down as well. It was only that period from like the 1970s all the way through close to COVID where that is somewhat of an inverse correlation. But those dynamics have kind of played out, globalization, falling in low inflation yields, et cetera. So you can definitely see that going forward. Is one of the reasons why we believe in finding alternative sources of ways to generate yield and income that are just uncorrelated to traditional bonds. And I think that's going to play out pretty well over the next decade or so.
I think the difference between
common way people are doing that these days is they're using alternative asset strategies again. They've stumbled into these things and gotten killed, stumbled into them. We'll see if they get killed this time. But they tend to gravitate towards pipeline investments and traditional old dividend payers like telephone utilities. Electric utilities aren't the game today for yield because they've become a growth vehicle, but a minor growth vehicle. But nonetheless, these are the types of alternatives that people are using in lieu of bonds to have a more stable asset value and yield.
Carrie.
One of the things that's different today is that I get a sense that where, back last time this went on, we were in an environment where we were a lot more concerned about growth slowing, where right now we actually are in a pretty nice pattern of growth. And with the Trump presidency, I think that we'll have a tailwind there, given that he is very much pro corporations. Now, don't get too excited, because the way that I look at this is that some of those policies, at the end of the day, it's kind of like you get a real sugar high, and then there are some unintended consequences down the road. For example, regulation. Yay, we get to lay off all of our compliance people because we don't need them anymore. But then what's the unintended consequence of not having regulations? So you have to be really careful about that. I think that we potentially this year may play out just for continued normalization of interest rates, and this may be the new norm. Inflation is still very, very much a concern. We've actually seen the price of oil kind of reaccelerate. That's a big contributor and has impact for all of us. So there are some areas of the market that we really need to keep our eye on. And as Michael said, it really relates back to interest rates and what is going on with inflation.
Okay. Kim, your thoughts?
And I'll wrap this up maybe. I think it could happen. Sure, why not? And I think the correlation between the inverse correlation where, if stocks went up, bonds went down and vice versa, was happening largely because we were in a bull market for bonds. That we started in like 1983 where we had ridiculously high 30-year rates and people would trade those bonds, and as they fell, it was a no-lose situation essentially for bond traders. I'm not going to get into the math of this, say thank you, but just so we've normalized that now that we ran through those really high bonds of the 1980s. But that's neither here nor there. So what are we going to do this year? Inflation is really a concern. And I think that the bond market had a freak out and an unnecessary freak out. You know, for the past couple of years, we've had really hot numbers from the job numbers in January. And I believe there is some sort of adjustment that's going on in the Bureau of Labor Statistics that they then unwind in like somewhere between March and August, where they go, ooh, we calculated wrong. We were trying to smooth out the curve, and they didn't. So I don't think jobs were nearly as hot, but I think this is more of a Goldilocks kind of okay economy. I don't think it's all that strong in many sectors. I think some are strong, some are weak. It's just what happens in a regular economy where we have a kind of a cyclical slowdown in some industries. Other industries are picking up, but on the whole, it looks relatively healthy. So I think it's setting up for 2025 to be an okay time. We'd all love to see inflation come down. And I think that this last little bit to get inflation from 3% to 2% is going to have to depend heavily on my favorite, technology. Because technology is deflationary, right? So let's see what we can do here, tech people. Let's get out there and make people more productive.
Yeah, get out there. All right. Well, we're talking about interest rates, and of course, mortgage rates are tied to the longer-term bonds. And at this moment, it doesn't look like there's going to be any help for the housing market anytime soon. Mortgage rates hit a high on average of 7.22% in 2024. They are on the rise again, with Freddie Mac tagging mortgage rates last Thursday at 6.93%, which is the highest rate it has been since early July. So, Frank, what is the long-term impact if the housing market continues to struggle?
Well, the housing market has more problems than interest rates. We have an incredible shortage of homes. And with hurricanes and fires, that shortage is growing faster than homes can be built. We're going to have a problem getting materials to the places that they need to get to in order to build these things, or materials at all, which will add to the inflation fuel, which will add to the rise in interest rates, which is kind of self-correcting. It'll slow down the demand and maybe make it possible to get those things in line, which they are not. And it's amazing to me at $300 a square foot or whatever it costs to build a home today, how anyone can afford these things, let alone a normal person. But they seem to find a way to get it done anyway, because the supply of homes for sale is small. You and I aren't selling our homes anytime soon, Stacy, to make room for young people. And if we did, the price would probably be too high anyway. And consequently, there's a huge number of problems, and interest rates is merely one of them. And if interest rates came down, the other things are still going to be there, creating problems. And pricing is a big problem too. And but people are making, an average person's making what? I think maybe the average family's making what, $80,000? I don't know what the median number is. And $80,000 means they can spend maybe $2,000 a month on a place to live. Can't buy much for $2,000 a month.
Not at this time. No, you're right. Carrie, Michael, any thoughts on this?
Well, I mean, it's definitely a factor in, the affordable housing crisis that we have in this country in general. And then you add on top of it these rates. And the concern that we have is, a strong housing market is really important for a strong economy. There's a multiplier effect when someone buys a home, because they then go to Home Depot every night for like 3 months. And they fill that home with stuff, and generally new stuff. So, if you have a housing market that struggles, there will be some domino effect into the overall economy in general. So it's something that we're keeping our eye on pretty closely.
I'll throw out one more thing about the housing market here, and because I've just been going through it, my homeowners insurance and car insurance, and the umbrella policy, I bundled them. They're all due in late January, and my current insurance company, I have not filed a claim on any of those things in 15, 20 years. My increase is 25% overall for
Whoa.
all of those. And there was an article in the Wall Street Journal recently that the number of people who have insurance premiums higher than their mortgage is growing leaps and bounds. So I guess this nobody was prepared for this, but I'm going to throw it out anyway. What will this A do to the housing market, and then B, is this necessarily mean that the insurance sector is perhaps a good one or a bad one to be getting into? Personally, I'm going to go ahead and say this too. I think there's going to be a backlash of some sort. I think that when prices go up this high, premiums go up this high, somewhere along the line, consumer is going to complain, and a legislator and legislators are going to take action on it. Now, whether they're successful, I don't know. But there, I threw it out.
To
Silence is golden.
To fundamentally discuss the insurance business, Stacy, you have to recognize that what casualty insurance is doing is taking the projected losses in whatever area this insurance company is operating in and spreading that risk among all the policyholders somewhat equally. Consequently, when there's fires in Florida and hurricanes or fires in California and hurricanes in Florida, our premiums are going to go up a little bit because we're going to help spread that risk around for everybody, and the insurance company isn't doing it for nothing. So they need to make a profit in order to continue to do this. For us in Pittsburgh, where we have relatively low catastrophic risk, we end up paying a little bit more because Florida and California don't have low catastrophic risk. But that's just the way the industry works. On the car side, car premiums are going up because cars have gotten so complicated. I mean, I think they have cameras in the paint now. I mean, it's ridiculous what's in these cars. And so you have somebody bumps into your car with a grocery cart, and you might have to spend $2,000 to get it fixed. And it's become, all this technology, Kim, has created a very expensive computer on wheels. And when it has a wreck, it's not easy to fix. So our premiums are going up because the vehicle is so much more complex than it was 30 years ago.
Well,
Absolutely.
only thing I will counter on that, and I'm going to let Kim speak here, Frank, is when you said our rates go up a little bit, double-digit increases are not just a little bit in my mind. But anyway, go ahead, Kim.
Yeah, but they're going up 100 and 200%
It's funny.
in Florida. Go ahead.
Years ago, I went to Interop, which was it's a super nerd out networking conference in Las Vegas. And one of the primary sponsors there was Mercedes-Benz. And why were they there? They knew that the car was going to become an information delivery device, is how they put it. And that has stuck in my head ever since. And gosh, aren't they right? I just bought after 17 years, I bought a new to me car this year. And it is I had an advanced car before, but I'm getting texts from my car. I'm getting all this information as I'm zipping down the road more safely than I ever cared to be, because it's telling me how close people are. So yes, I understand all of the technology that goes into a car. But looking at insurance companies, they have, their charter is to make money off of your money, and they've been doing it through bonds for forever. And they've just been getting killed the last 15 years because they couldn't put their portfolio to work in a way to get, a good return. So that's part of the problem here is they got burned by needing to invest in bonds because that's, their charter. They can't do terribly crazy things with the money they invest. So this is all a side effect of not only are things getting more expensive to fix and thus generate higher claims, but they've not been getting the returns to keep up. And it all kind of is syncing up, and it's miserable to be somebody that owns property and has to insure it. I feel your pain.
All right.
And to throw gasoline
Michael,
on
any
that
thoughts at
fire,
all on the insurance?
insurance companies are big mortgage holders on commercial properties. For instance,
Yeah.
the One Mellon Square downtown, the mortgage holder, and there's rumor that BNY Mellon's moving out of there, and this building's going to be foreclosed upon, as many have been downtown. And if you look at who lent them the money, often it's an insurance company. So not only are they not making money in the bond market, they're losing money in the mortgages they made in commercial real estate, which used to be kind of a guaranteed boring thing. Not anymore. So the insurance companies have a lot of problems. And these wildfires are I mean, it's amazing.
Yeah.
Okay.
And Stacy,
Yeah.
I don't have anything super poignant to add to that, but in regards to the interest rates for homeowners or new homeowners and the supply of inventory, I've been thinking about this a little bit. I think the insurance problem that we just talked about is a much bigger, longer term problem than those two things. And my fear is that what you pointed out before, legislation is going to get involved. I mean, nationalizing something, it's always more expensive to do that than it already is on the private side of things. But it's hard to argue that something kind of needs to be done, but I don't even know what that even begins to look like.
Yeah, I don't either. But at least you're in agreement with me that this can't go on because people they're going to stop buying insurance, and then
Right.
people
So
will
if
have
you're
losses
looking
and all
for an
that.
excuse for why the market's not going to go up and maybe have a next big down swoon like it in '08 and '00 and '87, we're about 10 years later, and it's every 10 years something happens. And this year it might not be the banks, it might be the insurance companies.
Yeah, who knows? I brought that
I don't
up.
know.
Okay, we need to move on here because I do want to get to this. Most of us get all excited because there's the holiday season, the Christmas season. Kim, though, gets excited 4 times a year at least, maybe 5 with adding in Christmas, because it's the earnings season. And you look at the smile on her face; she's ready to go. Talk about it, Kim. We're getting what fourth quarter results are coming out now.
Well, excuse me. I had too much Christmas and got sick. So it was the happiest time of the year. Okay, I'm back. So yes, on January 15th, we're going to hear from the banks. They are always first to tell us how they're doing. And it's always an exciting time for me, not only because of earnings season, it tells you who's the winners, who's the losers, and more importantly, what these companies are seeing about 6 months in the future for most of them. The banks are exciting because they're going to show us what's happening right now in the economy. They don't have much of a pipeline. Like most, even tech companies know what they think they can sell in the next 6 months. There's a sales process. Banks give you kind of a vital sign of what the economy's doing now. And that's why I get excited for those first few drib drabs of information that's coming out. It's probably not going to inform us how the rest of earnings season goes, but it will tell us how healthy the economy is. And again, that will be on Wednesday and Thursday of this week, and today is Monday. So in 2 days, look for those results. I think our biggest headline here is what are costs doing to companies? And that's what we're going to find out in this first quarter. We've seen inflation fall in 2024, and we don't know where it's really going, but we'll see how companies are thinking what they see is coming up in inflation and what they're allowing for in their earnings. And I think that is very informative to investors of any stripe, is to see what is in the future for these companies. So that's what I'm looking forward to in the next 3-ish weeks.
Okay. Anybody else want to jump in before we go?
Are you looking for
Like as Kim said, it's always a
prognostications? I'll
very
tell you what
exciting
Standard
time
Poor's
to-
thinks.
All right, go ahead, Frank.
Standard & Poor and I always quote or GAAP earnings. Kim talks about operating earnings. Having operated a company for 40 years, I have to say that Uh, I always budgeted for outside events because they always happen. So I look at GAAP earnings as being more meaningful. Operating earnings eliminate what they say are non-recurring items, and generally those specific items are non-recurring, but there's always non-recurring items. So it doesn't matter much. They generally run about 10% apart, and every once in a while it gets a little bigger, and every once in a while it gets a little smaller. And in 24 it was a little smaller, the spread. So at the end of the third quarter, we had $200 of GAAP earnings in the Standard & Poor, in round numbers. On January 4th last year, they projected $208. So they came in about 4% below projection a year later. That's actually pretty good for Standard & Poor. Normally, the spread's wider. This year, they project that for 2025, the S&P is going to earn $250. So if they're 4% short, that means they're going to earn $240. I'm going to bet they're going to earn $230 if we don't have a recession. And that being said, we're trading at somewhere around 22, 23 times expected earnings for 2025, adjusted by me. Okay, and that being said, with these interest
All right,
rates, that's
Frank,
not
we do.
high.
Okay.
Go ahead.
Carrie, I'm going to let you wrap it up here.
Yeah, I was just going to say it will give us a really good gauge as to how we think 2025 is going to play out. So stay tuned.
All right, sounds good. Michael, any quick thoughts at all you want to throw in? Okay, that's great. Thank all of you for joining us once again. We will continue to look at investing in the economy in our future editions. Ask again that you hit the subscribe or the like button on whatever platform on which you happen to be watching or listening to us. And for right now, thanks for joining us, and we'll see you again in about 2 weeks on another edition of The Bull, the Bear, and You.